Welcome to another edition of Midweek Moment. June, as noted before, is our education month, and every June we approach topics that are critical to both spiritual and natural education and elevation. In the past year, we have covered financial foundations, and now this month, as you all have seen in the previous three episodes, we will be tackling our wealth building series. Particularly, we will be focused on all things real estate. Real estate is a hot topic in the market right now as we are in the thick of the pandemic and experiencing the great resignation. People are seeking three key things: purpose, placement, and prosperity. People are seeking purpose in their lives. What am I called to do, they may ask, or what am I passionate about? People are also seeking placement in their lives. They may ask, where should I exercise that purpose? And people are also seeking, last but not least, prosperity. How do I live out my purpose in placement while still making financial gains? People are seeking purpose, placement, and prosperity. Well, you are in for another treat this week as we continue with our series, All Things Real Estate, with our resident expert, as I have now affectionately called her, Katrina Robinson, who is a very knowledgeable veteran in the business and no stranger to the South Suburban Church family. As we stated before, Katrina is a loan partner at Summit Funding Incorporated, and she has been in and out of the industry for 22 years. So again, for our final week, I would like to welcome back on the platform, Katrina Robinson. Hey, Trina.
Everyone, how are you?
Good. It is so good to have you. Thank you so much again. I'm excited to have you back on the platform. As I mentioned before, this is unprecedented. We have never had someone for 4 straight weeks outside of our pastor who used to do her week to week moments. So you should definitely consider yourself very, 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 very special to us. So thank you so
Yay!
much for joining us for 4 weeks straight. It was just something that needed to be done. As I mentioned to you before, when we kicked off the first session of this, people were just so excited and so pleasantly surprised with the knowledge that you have provided to all of us regarding real estate. And what I appreciate about you is you're well versed in all topics. It's not just one area of real estate, but you really can speak to pretty much the whole process. And that for me was just pretty dynamic. And so I felt like it was best to just kind of continue going with the good vibes because obviously that's what you're bringing to the platform. So thank you so much again. Your knowledge, your expertise, it is definitely on full display. And so we are definitely appreciative and we feel very privileged to have you on the platform again today. So let's dive in. I know this is our last session and I wanted to kind of just frame this session around how can we give resources to those that have been listening. I think we've talked about obviously, definitions that are key to real estate. That was our conversation last week, as well as renting versus buying. We've also talked about investing in real estate, owning personally, but also owning real estate for investment purposes. So we've really covered a lot of key topics around real estate. But this week, I wanted to focus on particularly real estate programs as well as housing programs and really breaking down the loan process. I think a lot of times, many of us, as you so articulately stated last week, we may not understand the lingo, and there's key things that we should kind of go into the real estate buying process knowing as far as our definitions and language, but then just understanding the process in its entirety. What type of loans are out there for us? And then if you aren't in a position where you can kind of go through the traditional process, there are housing programs. I'm still so excited about this because I'm just now learning this personally. So I think it is so dynamic to know and to give that information. A lot of people aren't aware of these programs, but there are housing programs to really set up buyers in a very profitable way, especially when it comes to the marginalized communities. I think a lot of times we're kind of blocked from certain processes and procedures because although we understand that from a legal perspective, affirmative action is definitely in place, that legislation is not always and forever implemented. There's also prejudice as well,
Yes.
prejudice
Yes.
around the process when it
Yes.
comes to buying process.
Yes.
And so because of that prejudice, there are definitely programs out here that can help us get ahead of the curve or also just be on par with our peers, our majority peers. And so with that, I'm looking forward to speaking with you about some of the programs and the loans and things like that on today.
Okay.
Okay, so let's dive into our first question on today. So, what are the different mortgage loan offered to potential home buyers? What are the different mortgage loans offered to potential home buyers?
Sure. So there are four different type of loan or loan types, mortgage loan types that you are able to obtain. They are conventional loans, they are FHA loans, they are VA loans, and they are USDA loans. Conventional loans are in place for, and all of these loans are for one single family home, which is considered a 1 unit, up to a 4 unit. Anything over 4 units then becomes commercial property and or mixed use. And mixed use properties are where there are apartment buildings on the top and there's a garage or there's a strip mall or there's storefronts on the bottom. So those are mixed use, and commercial properties are anything over 4 units. And then, of course, mixed use is considered commercial. So all of these programs or all of these loan types that I'm speaking to today are specifically for single family to 4 units. Okay. So you have your conventional loans, which are basically for your more higher credit score borrowers, more stable on their job, more savings in the bank, and your low debt to income ratios, which is what we spoke to on last week. Generally, conventional loans require anywhere between 5 and 10% down. And for your best interest rates, you have to have over a 680 credit score. And usually, when you get to 680 and you get up to 750, then your interest rates begin to go down. So anything over 750 and higher, you're in the excellent credit score range for a conventional loan. And then anything between 680 and 749, you're kind of in the good. But you can also qualify for a conventional loan with a credit score as low as 620. It just depends on what that credit score looks like. Sometimes your credit score is low, not because of derogatory credit, but it could be the lack of credit. A lot of people think that sometimes you can boost your credit score by adding yourself as an authorized user on your mom or your spouse's credit cards, and that does help to boost your score. But the main thing is to make sure that you don't personally have any collections, any charge-offs, and then you have at least 1 to 2 open credit lines that you are the owner of, that is actually in your name, and you're not just considered an authorized user. That is what will also opening up new lines of credit. So if you have new lines of credit or you've maxed your credit out, that will also drop your score as well. A lot of people don't even know adding a new address, changing your name can temporarily result in your credit score dropping. So just because you have a lower credit score does not necessarily mean it's due to derogatory credit or the lack thereof. So conventional loans, they have a tendency to have better interest rates, of course, as I stated, higher down payments, which will ultimately lower your monthly payment. And then you also have more stability on your job. So anytime you have at least 2 years on one job and you have some savings, that's where we begin to kind of go the conventional route, just because we want to try to get you a lower interest rate.
I want to just ask a question
Yeah,
really quickly
sure.
here because I think this is a really great point. So and I think kind of what we'll do throughout this conversation is just kind of like do a myth buster, if you will,
Yeah,
because I
sure.
think that some of the information that you shared is very powerful and a lot of people may not be aware. So I've had conversations with people that were really asking advice around, what do I need to do from a financial management perspective, budgeting and things like that to save up for a home. But then the conversation always comes down to credit score, right?
Mhm.
And so, to your point, You don't necessarily have to have a 720 or higher to apply for or even qualify for a conventional loan. We talked last week about the difference between pre-qualification as well as approval, right? So
Mm-hmm.
you could technically be approved for a conventional loan even with a lower credit score, but it's also considering other factors. So if I'm hearing you correctly, and please correct me where I'm mishearing, in the case where your credit score is lower, however, that just may mean that you are then subject to a higher interest rate than someone else that may have a higher credit score, for example.
That is absolutely correct. That is absolutely correct. So it is almost like going to a car dealership and you go and you can have a 580 credit score and they will give you a car, but they're going to charge you 30% interest. Opposed to someone going to a car lot, they have a 700 credit score and they get, 1% interest. And so, yes, you absolutely can qualify for a mortgage, both conventional for all of the programs, quite honestly, with a lower credit score, but just understanding that it's going to adversely affect you or impact your interest rate and the cost. Your interest rate is based on the cost that you will be paying over your term for to borrow that money to get that loan. And so,
Exactly. And I
yeah,
wanted to just touch on that as well, because a
yeah,
lot of people don't understand why the interest rate is so critical. It's literally the cost to borrow,
that
right?
is correct.
So for
That is
me to
correct.
borrow $300,000 for a home, they're going to charge me a fee of 10% on top of that $300,000, which would be $30,000, for example. I'm giving a kind of
Yes,
extreme
yes,
scenario. So you'll
yes.
be paying maybe over time $30,000 of interest just simply to borrow that $300,000. Why is that important? Because that means your mortgage payments on your home will be then higher than just what it would be if you were to straight line or annualize $300,000 over the term of the loan, right? So it's really all about how much can you afford. And so when you think about that, how much can you afford? Interest is key. And so I
Yes.
think a lot of people tend to say, "Oh, it's fine." The interest really, really tax on to the payment, and sometimes people can't even really afford a home because of high interest. And to your
That
point,
is
that goes for
correct.
cars, that goes for anything, right? So we have to be very, very careful with interest. So just to quickly jump into,
Especially, and just to piggyback, especially when you are not paying any additional towards your principal, because
mhm,
then you are still paying monthly. If you don't apply anything extra to your principal over those 30 years, you're still paying that 10% of that 300,000. That 300,000 doesn't go away until probably year, 20, year 17, because they apply most of your payment to your interest payment first. That is the way the banks make money, because that is the money that they use to lend to other people. That way, when you go and pay off your loan, then they get the majority of the original loan amount back at that time. So
absolutely.
that's
And so I
how it.
guess my question to you would be, just to quickly divert and then get back on track,
Yeah.
is what would you consider to be, a fair interest rate? So when we talk about targeting kind of that ideal interest rate when buying a home, particularly in this market, right? Because we know that this market is different than last year's market, is different than the prior year market, right? So in this current market, considering the volatility of the market that we're in, as well as the fact that this is in fact a seller's market, what would you say is a reasonable, um, you know, average point or midpoint for a good interest rate that we should be seeking out?
Yeah, sure. Again, it depends on the loan type that you qualify for. So conventional, of course, would be the way to go. It's a larger down payment, of course, but it's a lower interest rate. If you are a good credit borrower, you have savings, you've been stable on your job, and/or you are retired and you have Social Security, disability, any type of pension or annuity fund. Then the target right now in today's would probably be somewhere around 4%. Earlier this year was somewhere around 2.5. So that just really kind of, it depends on the market, and it also depends on your loan officer. To be quite honest, because Our fees and our income are generally commission only, and it is based on how much interest we lock you into, because there are our commission is also based on, it comes from the back end. That's kind of the way that we say it. The higher the interest rate, the more of a commission the bank is able to make when they sell the loan, and ultimately the higher commission the loan officers will make as well. So it's very key that you get someone that is knowledgeable in the business, but also someone that you trust, because one loan officer can tell you the best interest rate you can get is a 4.5, and then you go to someone else and they say, nope, I can beat that, I can get you a 4%. So you just need to make sure that you take all of that into consideration. For FHA and for VA, I'm sorry, for FHA is a little higher. Why is FHA a little higher? Because it's a lower down payment. So, and it's a lower credit score requirement as well. So it's a higher risk. And so the
And so
target,
what does FHA stand for,
yes,
Katrina?
Federal Housing Administration. So the Federal Housing Administration is basically a government-backed program that allows you to become a homeowner with more challenged credit, um, more volatility in your employment history, as well as less amount down and the less amount that you have to show for reserves. And reserves is basically just your savings, how much you have in the bank in case you lose your job today. Do you have enough to pay your mortgage for 2 months, opposed to conventional, which generally requires anywhere from 3 to 6 months. It just really kind of depends on what the total outlook of the borrower is. So with FHA requires a 3.5% down is your minimum amount that you have to put down. However, you do qualify for the different programs that we will talk about earlier, but then your seller can also contribute to your closing costs by giving you a closing cost credit. And so there's so much that we could get into with this topic, trust me. But the main thing is just understanding conventional is um, uh, lower interest rate, higher down payment. FHA is higher interest rate, lower down payment. So those are the two main programs, or loan types, not programs, loan types that a regular buyer would qualify for. The other two are VA, and VA is, of course, the Veterans Administration. With the Veterans Administration, they have so many different perks that come to veterans. I mean, it's amazing. I really appreciate the fact that the government has put these things into place to help our veterans who have fought for our country. And thank you to anyone who is watching for your service, both past and present, and future. But veterans actually can qualify up to 100% debt ratio. So your income really is not taken into consideration. We have to prove it, of course, but it's not really tied into the approval of your loan. It is applied to your certificate of eligibility, which means that you have an honorable discharge, and or you have active duty, or you are in active duty, and whether or not you will be re-enlisting. Those are really the main two requirements that we look for with the VA. Now, with VA loans, of course, it's more paperwork for sure, but then VA loans are even less in interest than conventional loans. So you can top out right now at about a 2.75 on a veterans loan, and that's both on a purchase or a refinance. Generally, it's zero deposit down. And my veterans out there, please know that if you do have an honorable discharge, check with your county, because at a certain point in your mortgage history, or during your mortgage loan, you qualify to be real estate tax exempt, which means they will take your taxes off of your property. So make sure that you talk to your tax assessor, go to your different county, and find out what the requirements are for you to apply for tax exemption, because that is
Wow.
huge.
That
That
is,
is such
when you
a
said that, I was
huge,
just like, wow.
yes,
It kind of was a delayed response, but when it clicked, it clicked. Because
yes,
that's one of the things I hear often with when it comes to homeowners, especially depending on where you live, the
yes,
taxes can be what just completely knocks you out the water
yes,
on top of what you're paying from a mortgage perspective, right? On top of interest. Then you have taxes, which
yes.
again can possibly sometimes be, I think, even more than the mortgage
It
sometimes.
can. That is
So
absolutely correct. Yes,
yeah.
especially if you're dealing with the higher priced homes
Mhm.
in the higher priced counties. They base it on income, they base it on school district. I mean, your taxes could literally be sometimes even almost double what your principal and interest payments would be every month. So, my veterans out there, definitely make sure if you are a current home buyer, you do not, or homeowner, you do not have to refinance in order to get your taxes taken off of your monthly bill. There is a process that you have to go through, and you do have to qualify for it. But definitely make sure that you look into that for sure. Um, and then the last one would be USDA, which is the United States Department of Agriculture. And that is the loan that people generally get when it's generally for farmers, but it's when you want to just purchase land. A lot of people are able to get USDA loans, again, for farmers, or if you want to purchase land to build on later. Some of those properties do qualify for USDA, and that particular program is much more strict. You have to have almost absolutely excellent everything, excellent credit, a lot of money in the bank. You have to be on your job for a while, but generally those are farmers loans. And so, and now, to be quite honest, it is because it's legal in a lot of states. It's also for cannabis fields as well, tobacco and cannabis fields.
Awesome. So that's very helpful. So we have the conventional loans, we have the FHA loans, which I heard you say the Federal Housing Administration loans,
That is
and
correct.
we have the VA home more
Yes.
loans,
Yes.
the VA loans, which is the Veteran Administration, and then you said the USDA loans.
Yes. United States Department of Agriculture.
Awesome. So those are the four type of loans. Ideally, where would you say you see most marginalized people fall into
For
category wise?
sure. For
Yeah.
sure. Generally FHA, especially when you get your first time home buyers, because they're just eager and they're excited to get into the home. And so the lower down payment they can put down, the better. A lot of people are not really interest rate conscious these days, which they really should be, but they're not. They're just excited about qualifying for a loan and being a homeowner. And so generally they'll go for the 3.5% down. Let me get as much credit from the seller as I can. There is a $1,000 minimum investment that has to come from the borrower, which most of the time is put in escrow for your earnest money. And your earnest money is basically what you give to your realtor to secure the contract. And the verbiage in that contract is what you're saying will happen. So what you're saying will happen is I'm going to obtain a loan for this amount, and I'm going to be in a position to close by this date. If for whatever reason you don't meet the terms of that contract and you default, the seller has the right at that particular time to keep your earnest money without refund, which again is why it's so important to make sure, as we stated before last week, or the week before, is to get an attorney and make sure that you understand the language in your contract and what it actually means, so that any money that you put down, if you as a buyer default, you're able to get your earnest money refund. But generally that $1,000 that you put down for FHA is most times all that borrowers have to bring to the table. It just really depends on what how the contract is written, what the purchase price is, how much the seller is willing to give you in a closing cost credit. And you also get real estate tax credits here in Cook County, because real estate taxes are paid in deferment. So, I mean, not deferment, they're paid behind. So taxes that are paid in
In
2000
arrears.
in arrears, yes. Taxes that are due in 2022 were actually the taxes for 2021. or you didn't own the home in 2021. You're just now buying it. So the seller has to basically give you a credit for those taxes because they will become due in 2022.
Yeah, this is great. Trina, as always, you are bringing all of the information. So this was super helpful. So as we're kind of on the topic of the different mortgage loans that we talked about, it does bring about this conversation of redlining, right? So we've heard this term kind of thrown around, especially when we saw at the top of the pandemic, when to your point, the interest rates were at an all-time low, we were still hearing kind of this idea of redlining and how it directly impacted marginalized communities. So if you could just please help us, I know we talked last week about definitions, but I think this kind of fits really cohesively with what we're discussing today. What is redlining and how does it in fact impact marginalized communities?
For sure. So redlining, let me just start off by saying it is illegal, okay? But it is a discriminatory act in which loans can be denied, as well as insurance can be denied and or priced based on the address. And the address is based on potential risk. The higher the risk, right? And so if we are in our low income neighborhoods, your loan and your insurance can either be denied, or the interest rates could be based on crime. It could be based on health conditions. It could be based on economic opportunity in that area. It can be based on environment. If you have bad water, a lot of people think that redlining falls under ECOA, which is the Equal Credit Opportunity Act, and it does. Don't believe me, it definitely does. The difference is that the ECOA is a law that forbids loans to be denied based on race, sex, marital status, creed, national origin, things of age, things of that nature. Redlining is discriminatory based solely on the address. It's based solely on the neighborhood. And so what some of the banks will try to do, and they've gotten away with, quite honestly, is not to deny your loan based on your credit or anything like that, but they will base it based on the potential risk. And that's the reason why they have insurances in place to help cover in case people come back and try to sue or anything like that. They have these legal teams to try to back them up on that, because they do hold a right to not lend in an area where they feel will be a risk on the return of their money. They cannot deny the individual, but they can deny the area. And that is the difference between ECOA and redlining. And it's a thin line. It is a strong, thin line. But
Yeah.
that's what it is if you go
Yeah.
into these bad neighborhoods where there's high violence, and there's it doesn't even have to be high violence. It could be, there are neighborhoods here in the state of Illinois where literally it's one or two houses on that block that literally somebody lives in it. Everything else is burnt up, tore down, boarded up, or something like that, and they can deny the loan based on that risk.
No, I'm happy you explained that. And I'm happy that you also stressed that there is a thin line because, as we know, right, it's almost implicitly stated or it's underlined. It's kind of this undercurrent in knowing that the majority of these areas that are considered to be higher risk are where marginalized people live, right?
Yes.
Black and brown people. And
Yes.
so, although to your point, redlining itself is not a discriminatory act towards the person, it indirectly or in fact directly impacts the person because we understand that that's those higher risk areas are where majority of the marginalized people are in fact living, right? And so it kind of does go hand in hand, but I'm happy that you did make that clear distinction between the two things. So that's really
It
good.
does. It does. And just also so you know, for buyers, there are a set of disclosures that you generally sign during the application process. The ECOA disclosure is one of those disclosures. However, if you read that paperwork very clearly, It simply gives you the Equal Credit Opportunity Act. It does not state anywhere that your loan can be denied based on redlining, which means based on neighborhood and potential risk. It does not say that. So that is the way that our banks and our lenders kind of cover their end of the track, is because you're agreeing that you cannot deny my loan based on origin, age, everything that falls under ECOA.
Mhm.
However, you can deny my loan if you as a bank feel like it's a potential risk. So definitely understand that that is how most banks and lenders get away with it, unfortunately.
Yeah, it's kind of the tomato thing for me,
Yes.
right? Initially, it was meant to be very two distinct, mutually exclusive concepts, but they run together
They do.
almost, right?
They
I mean,
do.
there's a lot of synergy between the two. So I'm happy you explained that. So let's move then to the next question here, because this is very helpful. We've talked about the different mortgage loans that are offered to potential home buyers, and then redlining and how that may or more so may or may not impact specific communities. We understand that redlining is more so speaking to the address or the location and whether or not it's high risk. So as we're talking about some of these things that are critical to real estate, and particularly that impact the Black and brown communities, when we talked about like FHA loans, or a lot of marginalized people typically are not as educated around certain things, and so we do have a lot of people that are more so needing kind of that assistance. I think this is a perfect time to kind of transition into the home buying assisting program. So this is something that I find to be just, again, uber intriguing. And I'm like an information nerd. I just soak it up. I just love knowledge. Like, it's just so
Yes.
exciting for me.
Yes.
And so whenever I tend to learn something new, I kind of just like dive into it so deep until I get sick of it, right? And then I kind of move on
Yes.
to the thing. And that's kind of where I was with this home buying assisting programs concept. I thought it was so cool, and I didn't even know that these things were out there, these tools were out there for people. So I guess my question here is, what are the home buying assisting programs? So let's define it first. And then after that, let's talk about what are some programs that our listeners should consider. So I'll definitely turn it over to you. A, what is the home buying assistant programs? And then what are some programs that our listeners should consider?
Sure. So home buying down payment assistance programs are generally grants and or loans that you can get from either your county, your state, or the government that will assist in you bringing less money to the table. And so you ultimately would not have to bring any money to the table. This is for your conventional buyers as well. So it's for all programs. The first three programs that I'm going to speak to are Illinois specific, and they are for all borrowers. So there's first time home buyers as well as repeat buyers as well. And they also are for all mortgage loan types. So it would be for conventional mortgages, FHA, VA, and USDA. Okay, so the first one is the IDA Access Forgivable program. And the Forgivable program basically will give you, they will grant you 4% of the purchase price up to $6,000. And the Forgivable program is basically where they will give you this money. It does not have to be repaid. What happens is that there is a lien that is placed on your property or put on your deed. As long as you stay in that particular home without selling or refinancing or paying off your mortgage for 10 years, you do not have to repay it back. After the 10th year, it will automatically drop off, and that is money that they gave you that you do not have to repay back. Again, this is available to first time home buyers and repeat buyers, not refinance. Just if
Mhm.
you are a home buyer and you're considered a first time home buyer if you have a mortgage within 3 years. So if I bought a home in 2019, in June of 2019, and I paid my mortgage off. If I get a new mortgage and I haven't had a mortgage since then, in June of 2020, I'm still considered a first time home buyer because that 3 year waiting period is now over. So You could be a first-time home buyer, or I could have a home and I could be purchasing a second home and I still would qualify. Okay, so that's a repeat borrower. So that is the IDA Access Forgivable program. The IDA Access Deferred program is basically you can get 5% of the purchase price up to $7,500. And deferred just basically means the loan does not become payable until you sell or until you refinance. So they place this lien on your property, and then when you go to sell your property or you go to refinance, that's when they will actually ask for a payoff on your loan, and they will add that into what you actually have to pay out when you get your money from your sale or your refinance. Okay, this is these are actually interest-free loans, by the way, just so you know.
Nice. Okay.
Interest-free loans. So the deferred payment is basically you pay for it at the end. The forgiveness program is that you don't pay for it at all. And then you have your IDA Access Repayable Loan. And your IDA Access Repayable Loan is also interest-free. And you will have monthly payments broke down over 10 years. You can get up to 10% of the purchase price and or $10,000, whichever is less. So those are those three programs specifically for Illinois that are both for first-time home buyers as well as repeat buyers. Now you also have First Home Illinois, which is specific to first-time home buyers. And this is a $7,500 grant. Again, this is here in Illinois, and it's specific to certain counties. So you just have to make sure that when you're talking about the different programs, that your loan officer is well knowledgeable to let you know whether or not the home and the address, here we go with redlining, but the address actually works and it fits into the county. But this is a $7,500 grant that they do not place a lien against your property. They basically give you a credit at closing for $7,500. It goes towards your closing cost and your down payment, and you are done with it. You just have to stay in this particular home for 5 years. So that's the First Home Illinois. Now, there are national programs out there as well. You can always go to HUD.gov, and you can Google down payment assistance programs for home buyers in your particular city, state, and or county that you're looking to purchase. Also here in Illinois, you also have the Neighborhood Lift program. You also have neighborhood housing services. All of these services have different grant programs because you also have like teachers and firefighters and police officers. If the city of Chicago has different down payment assistance programs, if you're a police officer in the city of Chicago, one of the requirements is that you have to live in Chicago. So they definitely want their city workers to purchase and not rent in the city in which they are actually, politically affiliated or working as a city employee. So they have teachers union programs, they have police officers and firefighters. So there's doctor loans. So there's just so many different programs out there that you can take a look at it. I would just highly suggest that you definitely call me because I'm the best in the business. Call me, shameless plug, but no, call me.
I love it.
Call me and I can work with you and see what's available based on your income. There's also DACA programs for our permanent resident aliens who are here on visas. There are programs to help them actually purchase. If you don't have a social security number, you can still get a mortgage. So there's just so much, and it's all based on each individual. But those would be the three most used programs here in Illinois, as well as First Home Illinois for our first-time home buyers. And then again, on a national perspective, there are programs available. You just got to get with the right loan officer that's licensed in 50 states, like myself, that can help you.
I like what she said. I'm licensed in 50 somebody. I am all the way here for this plug. Like, I love it, right? And proving itself out. Like I said, you've been with us week to week, just giving us so much information. What I appreciate about the down payment assistance programs is that obviously this is something that is necessary when you talk about kind of going back to the title of our series here, which is wealth building, right? Or kind of the overarching umbrella of our series is wealth building, specifically with real estate. A lot of Black and Brown communities, we weren't taught how to manage money or save, right? We've talked about this in other segments. And so these assistant programs are so critical because it helps you to still be able to have an opportunity to have ownership, right? And start creating kind of that generational wealth with some help, right?
Yes,
And so I really
absolutely.
appreciate that these programs are being offered. And for me, I'm just like screaming it to the mountaintops. Tell everybody, right,
Yes,
that hey,
yes,
there's help out here because some people predominantly avoid buying because they don't think they have the right credit score, which we kind of busted that myth, right? I told you about the
mhm,
myth busters. I
for
think there's a
sure.
lot of those. B, they feel like they don't have enough cash, liquid cash to put for a down payment. But when we're talking about conventional loans, that's one thing versus, as you've taught us today, an FHA loan, or again, applying for one of these, down payment assistant programs, right? So there's a lot of ways to still be able to buy. We
Yes,
just have to get out there and do the work, right? And I think
yes.
that that's what it requires.
Yes. One thing I want the viewers to really understand, especially from the perspective of what our topic is as it relates to wealth, right?
Mhm, mhm.
Just what I've learned in this business and working with different level income individuals is the wealthy stay wealthy most of the time because they don't self finance, right? They use
Mhm.
other people's money in order to start their business, in order to buy their homes, to make their money, and then they bank their money or they invest it in a hedge fund or they invested in stocks or something like that.
They
So I
grow their
said that
money.
to,
Yeah.
yes. So I said that to say is you can be the best borrower. You can have 800 credit scores and you can have $1 million in the bank. But if somebody is willing to give you a free $10,000, break your pride, find out what that program is because you qualify for it, and
Absolutely.
actually get that money to help reduce the amount of money that you have to bring to the table or the cost that you'll pay for anything that you do. So I really want people to understand that this thing about money and how we build generational wealth is not through your basic savings account at a bank. It's just not. It's through real estate, it's through knowledge, it's through the knowledge of how money works
Mhm.
and how you can use different programs that are available to us in order to build on what you already have.
No, I love that you stated that because
Mhm.
that disclaimer is required and is necessary. And we've kind of talked about this very minimally, but it's kind of been a common thread throughout our financial foundation series that we did last year. But even when we talked about, or 2 years ago, I'm sorry, then last year we did the reboot where we kind of revisited some of those topics, and the thread even still sticks here, right? I mean, no matter what we talk about, when we talk about wealth building, the key is to understand how to be smart, right?
Yes.
We have to work smartly, not hard. And a
Yes.
lot of times our peers are kind of already inheriting these skill sets. And so we do have to kind of conquer a bit more of a learning curve when it comes to understanding what is an investment, right? Why does it matter that I'm putting my money in certain investment vehicles? Or why isn't a savings account sufficient, right? Especially when you're getting
Yes.
0.00001%
Yes.
interest
Yes.
on the savings. It's not like
Yes.
how it used to be, right? So we've talked
Yes.
about these different things. And so I really appreciate that comment because there's two school of thoughts. And I'm going to quickly state this because we're kind of diverting, but I just want to, I think you just brought up such a great point. There's two school of thoughts. There's a school of thought where credit is bad, right? In the sense
Mhm.
of you don't want to have credit cards, you only
Mhm.
want to cash fund everything,
Yes.
right? And then there's a school of thought where it's like credit isn't
It's
bad,
necessary. It's
right? It's
necessary.
necessary, and it's all about how you manage it to your benefit, right?
That is
So
correct.
interestingly enough, I've been a part of both school of thoughts, right? When I first started on my own personal financial journey years ago, many light years ago, what it seems like now, that was my approach because I was like, hey, I need to get rid of these credit cards. I need to get rid of
Mhm.
this. I need to get rid of that. And I just want to focus on having cash, like liquid
Mhm.
cash. but then you recognize that that's not practical, right? Especially when you're talking about trying to build wealth or trying to acquire wealth, you need credit.
Yes.
You need it.
Yes.
Unless you are kind of a self-made millionaire, to your point, even the self-made millionaire is borrowing something, right?
Yes.
And
Yes.
so there's a misnomer when it comes down to credit. Credit isn't bad, but it's about how you manage it. And too much of it can be a bad thing, right?
Yes.
So it's about that balance. It's about
Yes.
both management, but also balancing. So I really appreciate that you stated that, because in all of these different scenarios, to me, I think the key takeaway is just to be reminded that you have to manage your money, even
Yes.
when it comes down to the down payment assistance program. That's great that you can participate in it, but at some point, you want to be able to self fund, right? Or
Yes.
be able to have that down payment yourself, so that you don't have to keep tapping into these different programs. It's all about learning now for later, right? And
Yes.
so I really appreciated that you stated that. So, Katrina, I know we only have a few minutes left here, so I want to kind of wrap up. There were some questions that came through last week.
Okay.
We did ask, a pool of few people that were coming back and just really enjoying the series. And so there's kind of more ad hoc questions, may not necessarily be related to the topic of,
Sure.
housing programs and things like that, but wanted
Sure.
to kind of get some questions in here and get your perspective. So the first question is, what is refinancing and its related benefits? This is definitely a hot topic, considering the market, right? And so if you can give us some insight on that, what is refinancing and the related benefits of refinancing?
Sure. So you do one of two refinances. You either cash out refinance, which is where you take some of the equity that you have in your property and you use that to pay off different credit cards or car, take a vacation, school loans, investments, whatever it is that you want. Or you have a no cash out, which is basically just a interest rate and term refinance. And so refinance is where you basically take your mortgage that you already have and you start your loan and your loan term over. Generally, people start to do that year anywhere between year 5 and year 10, unless there is an emergency that comes up. And the reason why is because you want your original loan to build equity. So you wait anywhere between 5 and 10 years, you'll refinance depending on whether or not your interest rate could be lower, which would be a rate and term refinance, or you have some financial obligations that you want to take care of, and you don't necessarily want to take out another personal loan. One of the advantages of doing a cash out refinance on your home is, yes, you pull some of your equity, but generally that is the longest term that you will have to pay over a loan. So instead of going to buy a car and getting a loan for 5 years and you pay $40,000 for a loan and your monthly payment is $1,000, you can get that same 40,000 put into your mortgage, and now you're paying it over a 30-year term. So now ultimately you would be paying 10, 15 bucks a month extra on your mortgage, opposed to having and you could go pay cash for your car opposed to having that monthly car note. So, or if you want to invest some money, or if you have college tuition that you have to pay for, generally that is what a cash out refinance does. It basically gives you some of the equity that you have in your home now at over a longer period of time, so you have a lower payment. And then a rate and term refinance is basically starting your loan over, but ultimately giving you a lower payment because your interest rate can be lower than what it was at the original time.
No, it's very, very helpful. Thank you for that.
Mm-hmm.
There's one more question that we had in the queue, and this is for renting to buy.
Yes.
So the question was, in the case of someone renting a full home, so not necessarily obviously renting like a unit, but a house, is there a way to then proposition the owner that you eventually are interested in purchasing the home over a period of time? And if so, what would that look like?
Absolutely. So a lot of homes these days, especially that are rehabbed homes, generally are leased with the option. And lease with the option is basically a 2 to 3 year lease term where you pay, and I'm just throwing numbers out here, $2,000 a month for your monthly rent. And then after that 2 years is up, you would then need to qualify either two things. You would have to qualify for a mortgage, or you would have to start the lease over. And at that particular point, the landlord would then be able to raise your rent up to whatever it is that they thought was the market rate. The benefit from that is that if you are in a lease to option buy contract, a portion generally of your rent is written in the lease that a portion of your rent will go towards your down payment. So you ultimately, let's just say your rent is $2,000, the agreement is $500 a month of that will go to your down payment assistance. Now you have $12,000 over the course of 2 years that you have sitting that your landlord will apply as a closing cost credit. And that can go, so you're ultimately saving without even knowing that it's there. You don't have to touch it. It automatically is kind of like 401k. You don't even see it, right? But you have to make sure that the terms of your purchase is in your contract up front. What do I mean by that? Is if the house is worth $100,000 today, that is the agreed upon purchase price in the next 2 years. You need to make sure that that is in your lease option contract, because if you don't, it could be worth 100,000. That's what you could be banking on. And then when it comes, your 2 year term is over, the landlord can say, okay, well, I want to sell it to you for 300,000 because that's what it's worth. And now you don't qualify for it. So the terms of a lease option agreement are very, very, very specific. And I would not enter into one without an attorney. Now, if you are in a rental situation and you want to approach your landlord, then that's when you would actually discuss the terms. If it's something your landlord would be open to, that's again when you would get both of your attorneys involved and rewrite your contract and either start your lease from that moment over whatever term it is, 12, 24, 36 months, or you would start it based on your rental history. It would depend on how the renters and the landlords want to structure the deal.
No, that's awesome. I'm happy you explained that so articulately, because it seems like a very complex,
Yes.
process, to your point. And I can see how without explicit stated terms in a contract, it can get very messy.
Yes.
You mentioned a few times, and we've talked about this both in this session and in prior sessions, about attorneys. I guess one of the other questions that came in, and I'm kind of also going to add a little bit to it myself, just out of curiosity, was we had someone to ask, is there a database where they can find a viable real estate attorney? Because obviously there's a lot of attorneys out here, right? And I guess to the second part to that question that I'll add to it is, how do you know if a real estate attorney is really offering you the best, fees, or are you kind of overpaying? What does that look like typically based on your expertise?
Sure, absolutely. And so I'm just going to speak from a buyer perspective, because a buyer perspective attorney is more streamlined. You basically are sending the attorney your contract. Your attorney is reviewing your contract. He's saying, yes, it's all good. There's no caveats that you have to be worried about. And then they show up at closing. Generally, the fees for a buyer's attorney is these days, anywhere between $500 and $1,000. That's reasonable. They used to be $300, and you could just, because all they're doing is just reading, and they do this. Real estate attorneys do this all the time, so it's fairly easy process. So anywhere between $500 and $1,000 for a real estate attorney. Most buyers obtain their real estate attorney directly from their loan officer affiliation or their realtor affiliation. There is no specific database. Of course, you could go to the Illinois Bar Association and get referrals. You may be able to go to some different neighborhood housing services and get referrals, but it's just based on the relationship that they have with that individual as well. So it's like, girl who did your braids, and I send you, a contact, and you go, and it's wonderful, right? But then So I send the contact to somebody else and, oh my God, my hair came out. And it's just really based on individual experience. But no, there's no specific database. Talk to your loan officer, talk to your realtor. Anywhere between 500 and 1,000. When you get more into real estate transactions for investment properties or from a seller perspective, because there's more work, then those fees can definitely increase.
No, thank you so much for that. That's very helpful. The last question that came in the queue, and we'll wrap up here very quickly. I think you kind of touched on it, but and I initially kind of skipped over it, but I think I should probably ask just in case for clarification. Is there a difference between refinancing and taking out a home equity loan?
Uh, yes, there is a major difference in refinancing and take out a home equity loan. So as I stated before, refinance is basically starting your loan over, whether you are going to pull out money or not. Home equity loans are HELOCs, home equity lines of credit. Well, you have two. So you have a HELOC, which is a home equity line of credit, and then you also have a second mortgage, which is also called a oh my God, I'm just like completely drawing a blank right here. But anyway, it's a home equity line. It's a home equity line, but it's also a home equity line of credit. So let me explain really quick. Home equity line of credit is basically like a credit card. You have $100,000 line of credit that's put on your home. You can draw against it to make repairs, and then you can pay it back. And then once you pay, you draw 50,000. Once you pay the 50,000 back, your 100,000 is available to you again. So you just kind of recycle that line of credit. A second mortgage, which can also be a home equity line of credit, is where they actually it's a closed-end mortgage. So basically, you get $100,000. They give you the cash, and then once you pay the 50 back, you have to refinance that mortgage off. You don't get an opportunity to pull the 50,000 back out again. You actually have to pay the loan off and then reapply for another second mortgage or another home equity loan. So those are the difference between the two. So one operates as a credit, kind of like a credit card, and then the other one just operates as a second mortgage that's placed as a lien against your property with a closed-in amount. So once you get that 100,000, you're done. You pay 50,000 on it. You have to pay it off and apply again. The line of credit, you get 100,000. You pull 50. You pay the 50 back. Your 100,000 is available to you to pull again.
Awesome. Well,
Yes.
thank you so much, Katrina. You were able to answer all of our ad questions, and we thank our listeners for sending them in. As we stated before, this topic, we could probably spend 6 months every
Yes.
week talking about real estate. There's just so much information, and it's a testament to even our midweek moments. We've been going almost a full hour every week, primarily because there's just so much information. We don't want to cut it out. And so we thank you so much just for your time. This has been a tremendous series. I'm so happy that we were able to get you on the platform here. And I just truly believe that God works things out the way that they should. And it was meant for you to be here with us for the full 4 weeks. So I thank you so much just for your time, for your flexibility, and for sharing your knowledge. I just believe that we have to be more open in sharing in our communities, not bottlenecking information, right? And having this crabs in a barrel mentality, but understanding that we truly all can win. And so it's all about getting the knowledge first so that you can then apply the knowledge and then spread the knowledge and pay it forward. And so I really appreciate you for taking the time and answering questions, giving us clarifications on misnomers or myths or just misunderstandings around the process. What I have learned from this series is that the real estate process is quite complex. It's quite complex. And so there's a lot that you need to know up front before you start this process, which is why if you listeners are in fact looking to buy a home for personal use or to buy a home for investment property, if you're looking to get more knowledge around the down payment assistance programs, or you're just curious as to whether you should continue to rent or buy, please consult Katrina Robinson, because
Yes.
she will give you the information that you need, as you have seen today. And if she doesn't have the answers, which I highly doubt, she knows, I'm sure, a
I
plethora
do.
of people, right, that will be able to, that she can direct you to,
For
whether that,
sure.
her own attorneys that she may be connected to,
For
or
sure.
other people that have the information within this space. So I really do encourage you all to reach out to her. Please remember, we know her as Trina affectionately
Yes.
here. But when we're talking on this platform, she is Katrina Robinson, the professional. So that means all information is confidential, right? You
That
don't
is
have to worry
correct.
about her calling the next person up talking about some girl.
That is
No,
correct.
this woman is professional, okay? And so I do highly encourage you all to seek her out where needed. And so, Katrina, I cannot thank you enough for, again, every week just coming with the wealth of knowledge, professional, showing up and just bringing your full self to the platform. I am just so grateful to you. Words cannot express. So, again, before we wrap up here, please, please give us your social media handles so that people know where to reach you, or any other contact information. And if you have any closing statements that you would like to share, please do so now. And before we close, I also just want to give a big thanks to our tech team that's
Yes.
behind the scenes, always just helping us out. Reverend
Yes.
Melanie Jones, and then also
Yes.
to our pastor of South Suburban Missionary
Absolutely.
Baptist Church, Pastor Annette Jones, who was so grateful and gracious,
Yes.
rather,
Yes.
in allowing us to share this platform this past month. So we are
Yes.
so grateful for the opportunity and for this space. So with that, Katrina, yes, please share your information,
Yeah.
and we'll wrap up afterwards.
Sure. First, let me just say thank you so much. I'm Minister Zanetta. I'm sorry.
Okay.
Just like you guys affectionately, she affectionately knows me as Trina. All I know is Pooh. I'm sorry.
It's cool.
It's just, yes, I'm sorry. So I always have to correct myself. But thank you so much for the opportunity. Thank you for trusting me, not only with your church family, but with your social media family as well. The main thing that I wanted to share is that it's so important that, as we grow and we mature and we get into our careers, that we understand that everybody brings something to the table, and
Mm,
it starts with home. It starts with family, and South
absolutely.
Suburban is my home. That's the bottom line. South Suburban is my home. And so I just really appreciate the opportunity to share what I've learned in my experience with my family, my TTs and my uncles and my godparents and my cousins and everybody. So thank you so much. I can be reached at Katrina via email at KatrinaMRobinson@yahoo.com. You can also reach me at Trina Robinson on Facebook. And then I'm actually going to give you my number. My direct dial is 708-275 2661. And my consultations are free up to 1 hour. I will give you and try to answer all of the information that, give you the information that you need. I do have access to realtors, even those that are directly connected to South Suburban as well. So we have realtors, we have brokers, we have agents, we have attorneys, we have insurance agents, because you will
Wow.
need homeowners insurance as well. So in any portion, any way that I can help you, either start the process, complete the process, refinance, or get ready to be a home buyer, I am here for you. As long as we keep God first and we pray, everything will be okay. I promise you. I got you.
I love that. She just brought another topic. I was like, we didn't talk about homeowners insurance, and that's a whole
Yes,
other conversation
it
in itself.
is. It is.
So what that tells me, Katrina, is that we will have to have you back.
Absolutely.
I don't know what God is going to speak for next year as far as the education series that we'll do. As I mentioned, 2 years ago, we did a 6-month workshop with financial foundations. And then last year, we kind of did this 4-week series where we kind of, circle back on, some of the things that were taught during that time. But who knows where God is going to lead us next year. But what I will say is this: wherever God leads us, I strongly believe you'll be a part of that.
And
So
I will be
you
right
are
there.
officially one of the, again, resident experts when it comes down to all things real estate. We have a few different ones in different areas, but when it comes to real estate, you are that. So thank you so much again for your time. And to our listeners, Thank you so much for your feedback. We appreciate you watching the videos, taking in the information, and just letting us know that this is information that makes sense for you where you are in your life today. It's meeting you exactly where you are. So we just continue to pray God's favor over your lives, that whatever it is that you are seeking out in this season, no matter what is happening, that God will continue to provide. Remember that delay is not denial. And so, even in the concept of real estate, delaying is not denial, right? But in fact, delaying is reassuring us that things are happening in the timing of God. And so, just continue to be encouraged through your process wherever you are. And again, thank you so much, Katrina. We love you all, and we'll see you all next year. Take care.
Bye.
Bye.